Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And we are on KFLE, The Answer, and what you're listening to is The Answer About Money. So the Money Show is coming to Seattle, June 15th and 16th. And I've been asked to do not just one workshop, but two, plus be on the exhibitor hall stage. So what is it? It's a show where they bring leading economists, renowned market strategists, top-performing portfolio managers to all share information, and it's free to those who are attending. The lineup right now looks like it's going to be Steve Forbes, Ralph Akamora, Bruce Johnstone of Fidelity, Larry Kudlow, who's head of the economic advisors for our president, Edward Yardeni, who I think is one of the great economists, Louis Navalier, and Mike Adams. How about that? What a lineup, huh? It's free. They expect about 2,000 people to attend over the two-day event. And this is the first time it's held in Seattle since the early 90s. So it's a big deal. I've attended the Money Show in Las Vegas for 3 years. I've attended the Money Show in San Francisco 1 year. And I've been asked to do a workshop in Orlando, Florida, coming up on the 7th of February. And I'll be there in Florida. We're going to do, I think, a live podcast from Florida, so you'll even be able to hear me in Seattle and what I have to say. Anyway, go register. You can go online, click on the Money Show and register. KLFE is going to be a sponsor as well as the Seattle Times. There's a Commodities and Futures magazine, or Technical Analysis and Futures magazine, going to be a sponsor as well. So it's a significant thing, significant coming to Seattle. And it's really significant, in my opinion, because I'm going to be there. You know, that's okay. So anyway, let's talk about what's going on. The Dow on December 24th, Christmas Eve day, plunged 653 points. And the day after Christmas, on December 26th, it charged upward 1,024 points. So what changed in those 36 hours? What really changed to make the Dow swing 1,800 points? So that's what we're headed to understand today, why that happened, what's going on, and what's happened in this time period from September to the end of December that drove the market down almost 20%. This is the time of year when you listen to TV, the CNBC, the Barron's, the Wall Street Journal. You have all the magazines that come out that talk about the mutual funds to own in 2019, the mutual funds to sell in 2019, the stocks to own in 2019, the stocks to sell that you had last year. The focus is on the short term, and I always have a problem with that. There's nothing specifically exciting that a year changes from 1 year to the next year, that on December 31st, you do away with the old, and on January 1st, you bring in the new. I think it's a process that has to go on all year long, but it is one of those things that we almost normally do. It's the past year is done, and it's time to look forward. And so we're going to do that as well. We're going to look at what the expectations are for 2019. Going to look back some and say what happened in 2018. You know, Yogi Berra said, predictions are difficult, especially when they're about the future. I like Yogi Berra. So I said to our administrative assistant, who is a lot younger than me, not far removed from school. I said to her, "Do you know who Yogi Berra is?" She says, "You mean the cartoon character?" I said, No. Yogi Berra. He was the catcher for the New York Yankees. He has all these sayings. Anyway, now she knows who Yogi Berra is, and at least one of his sayings. Yogi Berra said, "Predictions are difficult, especially about the future." So 2018 was a difficult year as it ended up. Not only were the predictions difficult, but I was wrong. I thought 2018 was going to be an excellent year. So what happened? In September, the Standard & Poor's 500 was up 10.6%. Adams Financial Concepts had a very good year. We were up 20.4% at the end of September. By December, the Standard & Poor's 500 was down 6.24%. First time it's been down in over a decade. I was happy that Adams Financial Concepts was up 0.95%, almost 1%. Can I say that we were up 1%? Not quite. It takes until about January 15th of the year to know exact numbers because it's Morningstar that calculates our client portfolios. It's completely done independently. It's not up to me. It's done by a third-party source so that there's no fudging of the numbers. They're the specific numbers that client accounts produce. And it includes all the accounts, including conservative, moderate, and aggressive accounts. It was a year in which I really expected that when we were up 20% in September, that we weren't doing as well as I thought we would do at the beginning of the year. To think that we ended up just 1% was not a great deal. So as I listened to CNBC, and in my office, if you come into my office, you'll see that hanging on the wall, hanging on my desk, there's 3 computers. Hanging on the wall, there's CNBC going all the time, and it always plays in the background. It's something that I don't pay a lot of attention to, but every once in a while, I listen to what people are saying. And some of the things that are being said now is that we've got a recession coming in 2019 or 2020. Or worldwide growth is slowing, and that's what the market has been telling us. Or most recently, I heard somebody say it's tax loss selling. Samuelson wrote a textbook, one of the most popular selling economics textbooks. And one of his quotes I really like very well. He said that the stock market has correctly predicted 9 of the last 5 recessions. Think about it. Stock markets correctly predicted 9 of the last 5 recessions. So having the stock market go down does not necessarily mean we're headed for a recession. The fact is that earnings are increasing, cash is increasing. Companies bought back $1 trillion worth of stock in 2018. All those things should be positive for the market, not negative. And yes, worldwide growth is slowing, but nobody's talking about worldwide tumbling into a recession or depression. It's slowing. It's not stopping or decreasing. And for tax loss selling, I always look at my accounts trying to make them tax efficient. So I go through every single account beginning in September, October, and I look for places where we can do some tax advantage selling. And I looked, and out of all my accounts, there were only 6 accounts that had any tax losses, only 6. And 4 of those accounts were new accounts in 2018. It's not tax loss selling. We've been in a secular bull market since 2009. We've seen the market triple from almost quadruple during that period of time. That means you don't have many people selling for tax loss. Most people don't have tax losses. So what is really going on? If you look at the statistics, and I'm a numbers guy, if you look at the price-earnings ratio, the price of the stock divided by the earnings, it's been fairly consistent over a period of time between 17 and 21. More often closer to 21 than to 17. But the PE at at the end of December ended at 15.5. That means there's been a lot of selling going on that's not related to what stocks are doing. And either one of two things has to happen. Either earnings have to tumble down 30%, or stock prices have to increase 30%. So here's my thought. Here's what I feel has happened. 60% of all trades are now executed by a computer. There's no human intervention whatsoever. A computer can read 2 to 3 pages of a news release and react within less than a second, faster than a human being can read that. I have daily candle charts. If you do anything about technical analysis, you know what candlestick charts are. They're part of the graph, and you can actually see what computers are doing, I believe. And you can see it was computer selling that was going on during this whole time in which the market was coming down. That's what's happening in my opinion. There are examples of what has happened when you've had computer selling going on. August 2nd, 2012, Knight Capital, one of the biggest beneficiaries of computer trading, was involved in a computer glitch. And we'll come back and talk about that. Right after the commercial break, we're going to commercial break. Don't go away. We've got a lot to talk about. What did happen that moved the market down so much?
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about what in the world happened between September and December that moved the market from plus 10% to minus 6% in that period of time. The Standard & Poor's 500 dropped. The Dow dropped that amount. So what was it that happened during that time? And I believe it was computer selling. I started talking about Knight Capital because Knight Capital, prior to 2012, used to do 11% of all the trades. That's a huge number of trades being done. And I said before that, actually, that was the time period January to May of 2012. And on August the 2nd, the computers went wild and it began to buy stocks. It began buying stocks at 9:38 a.m. and 14 stocks rose greater in volume than the Standard & Poor's Spider. That's the ETF. By 10 a.m., 51 stocks were above that. In a few minutes, Knight Capital bought $7 billion worth of stock, and it pushed the markets way up. And then, for every buyer, there's a happy seller. But when you get to that price, when you run out of buyers, what happens? When you really push things up, it begins to come down. And when the buying ended, stock prices began to collapse, and the algorithm began to sell. And in that period of time, Knight Capital ended up with a loss of $440 million. It would put Knight Capital out of business. In the previous year, Knight Capital's total revenues, not earnings, but revenues, were just $1.4 billion. On August 2nd, 2012, in less than an hour, they lost $440 million and ended up going out of business. So think about what happens when you're buying and selling. When you're buying, if you buy a stock at $40 and it turns out to be a real dud and collapses and goes to zero, you lose $40. If you sell short a stock at $40 and it goes up instead of going down, if you sell it short, which means you're selling it today expecting to buy it at a lower price in the future, if instead of going down it goes up, you have an infinite exposure to risk. That stock that you sold short at 40 could end up within minutes at 1,000 or 10,000 or $1 million. and you're forced to cover it. So think about what's been going on with the market. If indeed it is stock computers that are buying and selling, that means they've been selling for 3 months. And when they're selling into dark pools, or they're selling into market makers. And those market makers are going to wait until the selling's over, and then they're going to begin to price it up. But you get into situations where you sell down 653 points. And if there's no more selling to do, you get into a place of having to replace that stock that you sold on a short-term basis. You have to replace it. And suddenly you go down 653 points. And then within a day, you have to replace that stock. You're up 1,024. Now, if you can induce other sellers into the market, you may be able to replace that stock at lower prices. That's what we saw through this period of time. When I first started in the business, there was the New York and the American Stock Exchange, the Pacific Exchange, and others. To be on that, you had to buy a chair, and you had the right to make a market in certain stocks. It was physical. It was before computers. You know, what would happen when I got into the business in 1986 is you'd fill out a ticket. It would go to the wire room. The wire room would send it off to the New York Stock Exchange or off to a market maker on NASDAQ. And it would be executed by a broker. But what happened is there became huge volumes of stock. When you were trading a few hundred shares or a few thousand shares, market makers are obligated to buy when there's an imbalance or sell when there's an imbalance. And when you have a few hundred shares, you can do that. And what they'll do is they'll look at the books and look at the number of people that are buying and the number of people that are selling and the number of shares on both sides of the trade, and they'll adjust the price of which they're willing to buy and create equilibrium. But when suddenly you have somebody coming into the market and they want to sell 12 million shares of IBM or 35 million shares of Microsoft, that completely throws the balance off. And so what happened is you began to get third party off the exchange trades. Secondly, you began to also get privatizing the exchanges. Instead of being just the New York and the American exchange, there are now 19 exchanges, and the routing is specific to each one of those. I noticed at one time because I do my own trades, I buy chunks of stock, 100,000 or 150,000, and usually for a group of clients all at one time. And I noticed if I placed an order for 100,000 shares, normally you'd expect if everything was in equilibrium, 10,000 shares would go to each of 10 different exchanges. That's the way it was supposed to work. But I noticed a few years ago that I would place an order for stock, I would place an order on it, and it didn't fill. It increased in price by 10 to 15 to 25%. And it wasn't until I read Flash Boys that I realized what was happening is that the first order would go to an exchange called BATS. It would actually execute 100 shares. Then the computers would, before the second orders could be executed, the computers would drive up the stock by 10 or 15 cents, and they would sell the stock that they just bought milliseconds before my order got filled, the other 990 or the other 99,990 shares, before that got executed at another exchange. The computers would come in, buy the stock ahead of mine, and sell it with a nice 10 or 15% or 10 or 15 cent profit, or even 5 cents. If you do that enough, if you own 60% of all stocks that are traded, you make a lot of money on a very small amount. Speed is the key. So in 2010, actually, if you want to go back and think about how all of this is developed, in 2010, it was announced that some people had raised between $200 and $300 million to build a fiber optics network they called Spread. Stocks trade in the New York Stock Exchange on a cash basis. They're the actual physical shares. And futures trade in Chicago on the options exchange. Normal fiber optics networks run along rights-of-way, run along rail tracks. So there's a curvature to, and it's not a straight line. The idea of spread was to buy and put in a fiber optics network that was straight, exactly straight between Chicago and New York, 855 miles. I think around 855 miles. That was the idea of spread. And by doing that, because data travels at the speed of light, they were able to reduce the speed by 4 milliseconds, 4 1,000ths of a second. And so if there was a slight difference in the stock price in New York and the futures price in Chicago, they could take advantage of that, and before anyone else would see that, they had a 4 millisecond advantage of that. And through that, they'd spent somewhere between $200 and $300 million in putting that system in. It opened in 2012, and in 2012, they were selling the rights to use that network for $20 to $34 million a year, and they had no limit to the number of customers they had. That was the speed that is taking place on the New York Stock and the other 18 exchanges which are moving. Not only that, there are dark pools that exist. I talked about the third-party exchanges. Well, what you do when you've got 12 million shares of a stock to sell or buy is you begin to accumulate the other side of the exchange. If you've got 12 million to buy, you start to find sellers that'll supply the other 12 million, and you accumulate both sides of the transaction, and then you make the trade. So you have what are called dark pools now. The banks, the mutual fund companies, the brokerage firms. Merrill wanted a report to show that it was better. They were getting a better execution. They couldn't find that it was better for the clients to do it that way. All of that is going on. And if you look at where things are, all of that's taking place, and most people are still thinking about what the stock market was like in the 1990s or the early 2000s, that it wasn't a computer-driven stock market. Right now, it's very, very much a computer-driven stock market. Executions are done within milliseconds or microns of a second. And those trades happen so much faster. And the one thing you have to think about is that day trading and trading on technical analysis, you're competing against computers. And for the computers, it's a zero-sum game. Every time that a computer makes 10 cents on a stock, somebody has to lose 10 cents. On the long term, you have a stock market that's increasing over a period of time. So for me, it makes sense to be on the fundamental side rather than on the momentum side, rather than being on the technical side. It makes sense to look at how the companies are doing and not what their stock prices are doing, not looking at what the volume is doing. That's where you need to be. It's been a longer solo starting on this. I've got a guest you want to hear today. She's got a great story to tell. So right after break, we're going to talk to Natalie, so don't go away. She'll be right here, right after the break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So welcome back. I have a guest today, a story that is really important to hear. It's Natalie Hartkoff of Hightower Design. Welcome to the program, Natalie.
Thanks, Mike. Nice to be here.
So why don't we start with your background?
Sure. So Hightower is a furniture manufacturer.
But let's start with your background.
I will definitely.
Okay.
Absolutely. So we're a furniture manufacturer focused on office spaces. So my dad was in furniture for a really long time. And I am from here in Seattle. I went to UW. And while I was in school, he had always been in the industry. And we had this idea of kind of starting a company together. I had studied international economics and was able to kind of bring a younger design eye to the company. And it was a really great partnership. And so that's kind of how this all originated, was just kind of out of school and kind of a collaboration among the family.
So let's talk about Hightower Design.
Yeah.
Tell us about the company, what it does.
Yeah. So we produce furniture for commercial spaces. So we focus on tech companies, universities, high-end healthcare, all different commercial spaces. We started out working with some different Scandinavian manufacturers and really focused on importing when we first started. And I did sales for several years, and we started really gaining a lot of traction and identifying where the gaps were in the industry. And we started producing our own furniture to kind of complement what we already had from our Scandinavian partners. So we produce our furniture in North Carolina. We have offices around the country and a sales distribution channel.
So there's been a huge change in offices over the last 20 or 30 years. The cubicles have kind of disappeared. Open spaces have come. Some people still have offices.
Yep.
But tell us about what's going on in the office space right now.
Yeah, you're totally right. There's been a really big shift, and I think it's an awareness that the office design is such an important tool for recruiting top talent and also retaining them. And so that's become a competitive advantage for some companies over others based on the investments that you've made in your office space. And that's really aligned with the furniture that we've been producing, is really focused on collaboration, mobility, personal choice within the office of where you choose to work. And so that philosophy has really worked well.
So when you say choice of where you want to work.
Yeah.
I mean, traditionally, you had a desk, you had a chair,
Yep.
maybe you had a credenza.
Yeah. You were in your own, you were in your own office space.
And you had these barriers around you where
true.
the person in the next space had the
Yeah.
same thing.
And there are pros and cons, right? Sometimes
Yeah.
that's really good for focused work. But now we're finding, especially with the millennial generation, that they might want to work at a sofa with their feet up and use a laptop table. They might want to work in the cafe area at a cafe table and have a drink and have a snack with them as well. They might, they might camp out somewhere. They might want to be standing while they're working. So there's all these different options that they have. And that's really been something that we've seen as a huge transition, not only at the Googles and Facebooks and the high-end, the tech companies that have kind of always had those key office perks, but moving into much more traditional spaces, law firms and all different kinds of companies are really kind of embracing that work style.
And it doesn't cut productivity.
No, that employees feeling like they have that choice has really, I think, benefited. There are definitely pros and cons. Some people really prefer a quiet, closed-off space where they can really focus, and that's their personal style, and they should have that option as well. I definitely believe in having a variety of spaces within the office for people to be able to, again, choose what they want, and they might want that privacy.
And then you furnish the furniture.
Yeah.
Furnish the furniture.
We produce the furniture, and then we sell it through a network of commercial furniture dealers that actually sell it and install it at the client's office spaces.
So talk about what specific pieces of furniture a person would normally deal with.
Yeah, so there are kind of two different groups within our industry. There are the tables and ergonomic chairs and task seating. That's not what we focus on. We focus on the informal meeting tables, the sofas, the lounge areas, the stack chairs, kind of the more collaborative lounge areas of office spaces. So there's a lot out there. There's obviously also a lot of other product categories, but our focus is kind of on the playful furniture that you see.
Okay. And you produce a lot of that in North Carolina.
Correct. Yeah. So we
Other
have two
places
facilities
besides
there.
North Carolina?
Right now, most of our suppliers are actually within 5 to 10 miles of our two facilities in High Point.
So there's all this thought that we don't manufacture anything in the U.S. anymore.
That's true.
So tell us about that.
Yeah, we felt it was really important. Obviously, like I said, we started out as importers. I believe in the international trade, and that there are specific countries that have really great advantages. Scandinavian design is tremendous, but we also really wanted to respect the traditions of North Carolina furniture making, and really embrace the skilled tradespeople in High Point. So it was important to us to also manufacture domestically, and we really benefit. There's tremendous talent there.
So when you say tremendous talent, it raises the question, there's been a great move to automate a lot of jobs. Yep. So around the furniture, tell us, are you seeing that in your industry? Are you seeing that?
Yeah, absolutely. There are lots of tools for CNC cutting and a lot of different automation that you can do. We have chosen at this point in our company to focus on very hand-done, crafted furniture. So we still hand cut all of our fabric and assemble by hand, and we have a lot of upholsterers that are doing all of their work by hand. That craftsmanship, that quality is really important to us. Not that it's necessarily lost through the automation, but we have access to that skill, and we feel that's really valuable. But we're always keeping an eye on where that balance is of if we can increase our productivity or reduce our costs by automating some elements of it. We're always kind of weighing that. But right now, it's worked really well for us to still do a lot by hand.
I want to come back and talk about the office again, because right now we're looking at 3.7 or most recently 3.9% unemployment. If you go around Seattle, place after place has help wanted signs. The help wanted ads are all up. Mm-hmm. Right now there's a huge competition for labor.
Yep.
And so tell us about the advantage you bring with your type of furniture.
Sure. So again, right, it is the feel, it's the essence of the space that you're working in, and it's also a really important way for the brands themselves to express their brand visually, and also to communicate their most important core values. And so we're really seeing that the investments in office design, which to me heavily includes the furnishings that you choose to put into your space, really communicates a lot of important things about the brand of the company and can attract that top talent that you're looking for. And I think between two companies that might have similar quality of product and perks and things like that, if they're weighing it, they're often going to go towards the office space that has the best design and feel of it.
So what happens to some of the companies that, they've been going for 20 or 80 years or whatever, and they have their office space is now stuck in the 1970s. Mm-hmm. How did they get into the 2010s or 2020s soon coming up? How did they get there?
Sure. I think you have to evaluate for your own business what makes sense. If you're able to recruit the talent that you want with the type of space that you have, that works, right? You have to make those choices as a business of where your dollars are best spent. But if you are having trouble attracting the top talent, you're bringing them in, you're having interviews, and they're not taking the offers, right? It's really an important thing to think about and to assess how can I, whether it's observing other office spaces or asking candidates what's most important or asking existing team members what they might change around the space, really thinking again about the personal choice, bringing more opportunities to work outside of your personal office, and testing some things out. You can do it in a fairly economical way and through a phased approach to start making those steps towards a more modern office space. I definitely think it's possible.
So would you have someone contact Hightower to do that?
We definitely have a lot of great products that you can absolutely drop into different office environments. So you don't have to overhaul your entire office in order to add some great pieces that pop. But we would definitely recommend one of our great furniture dealers within the client's market to kind of help with that, the actual execution of getting the furniture delivered and installed.
So somebody could go to your website and look at that.
Yeah,
So
that'd be
what
great.
is the website?
So you can go to hightoweraccess.com to see our collection and to learn more about us.
And if they wanted to contact somebody?
Yeah, absolutely. Our terrific team in Kansas City, Missouri is our customer service team. And you can absolutely call them or contact them through our website. So the website's the best place to go, and all of our contact information is there. So again, hightoweraccess.com.
That's great.
Yeah.
It's really changed over the years.
Yeah.
You know, you
It
get some
has.
picture of Western Electric, when they did the study in the 1930s, I think it was, where psychiatrists came in and said, if you improve the lighting, and they started to improve the lighting, and the productivity went up, and then somebody says, if you really want to know, you turn down the lighting and see if the productivity went down. And so they started turning down the lighting, and productivity continued to rise. And what it showed is it was management understanding the workers
And what they wanted and what was most
what
important.
they wanted.
Yep,
And
absolutely.
they can do that through Hightower, right?
Yeah, absolutely.
Thanks for being on the program.
Thanks, Mike.
We're coming to another commercial break. Don't go away. I want to return to this idea. What happened and where are we going in 2019? Hang on. I'll be right back after the commercial break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm back again with that quote from Yogi Berra, predictions are difficult, especially about the future. They are. 2017 was a great year for the stock market, and I came out at the beginning of 2018 and said I expected 2018 to be even better. And it was until September. Bull markets can last a long time. Secular bull markets, you know, if you look back, the secular bull market from 1982 to 2000 lasted over 18 years. The secular bull market from 1941 to 1966 lasted for 25 years. Secular bull markets don't die from old age. Secular bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphemism. They don't die because of old age. And it seems like a lot of investors are worried that the market is old in the tooth and they've missed out, and the September to December drop did nothing to erase that impression. But I've been saying since 2009 that we live in a special time period. I've talked about the super cycle, the study that Standard Chartered Bank did that said there was a super cycle where the worldwide economy grows faster than average, and they last for a long time. The first one from 1870 to 1913, driven by the industrialization of the U.S. The second from 1945 to 1970, driven primarily by the rebuilding of Europe, the decolonization. And they said one began in 2009 that will last probably until 2030, not 2020, 2030. So that's the mile-high view of what's going on. And if you look at 1982 to 2000, we had the crash in 87, we had the recession in 1991, we had the war in 1991, the invasion of Kuwait and Iraq, Desert Storm. We had the recession in 94. We had setbacks during all those periods of time. But if you look at the total stock market in 1982, the market hit, in August of 82, it hit 1,000, and it finished over 10,000 in 2000. I've been saying since 2009 that we are headed for a period of time when we should be looking at a Dow of 100,000. We're 23,000. When we were 7,000, that sounded like pie in the sky. It sounded kind of crazy. How could I make that kind of prediction? I believe we're going to be there, and I believe there's some support to it. That supercycle is being driven this time by the emerging nations. By 2030, 93% of the world's middle class will live in what we call the emerging nations. We used to call them the underdeveloped nations. They're not necessarily underdeveloped. They're developing now. And so coming into 2018, I thought it was going to be a great year because in order to win in the elections, the Republicans passed a huge tax package. It was supposed to stimulate the economy. And I've said I had concerns about it, but it was going to be very good for corporations, very good for wealthy individuals, and it should have been very good for the stock market. Earnings were up almost 14%. That was something that should have propelled the stock market up by that amount. Instead, we get a stock market. Standard & Poor's 500 was down 6%. You know, the stimulus package was supposed to push GDP up over 4%. It didn't do that. But still, GDP grew some, and there were some positive things that happened in 2018. Profits drive the stock market, and profits were exceptional in 2018. Now you hear people talk all the time that, well, maybe there's profit warnings and maybe the stock market's trying to tell us that stock earnings are going to be worse. I wouldn't count on it. I wouldn't count on it at all. They may not be extraordinary, but they'll be better probably than they were in 2018. Not the difference we saw in 2018 to 2017, but they should be better. And that means there's a potential for the market to be very, very good. There's going to be more inflation coming along. Unemployment is now 3.7, or the latest numbers are 3.9%. That means there's a squeeze on wages, and wages are beginning to increase. I've talked for a number of years about the way that this secular bull market ends, and it ends in and about of high inflation rather than a great recession. You know, you can find these programs, by the way, if you go to our website. We do those, podcast. So without going through the details, the idea is we're beginning to see a time when inflation is increasing. Inflation is driven, as a rule of thumb, 2/3 by wage increases and 1/3 by commodity price increases. Both of those are increasing. Not oil prices, but other commodity prices are increasing, and wages are now increasing. For all the talk about the low blue-collar worker not getting an increase in real wages since the 1970s, what we're seeing now is there's a catch-up beginning to take place, and with 3%, 3.7, 3.9%, that I would expect will continue to increase. That will happen in 2019, and there'll be all sorts of people that raise all sorts of issues with that. But company profits will continue to grow, and when company profits continue to grow, stock market will eventually follow or maybe even lead. Worldwide growth is slowing. We've gone through those periods, 1982 to 2000. We went through an average period of time when GDP was just 2%, not 3%, not 4%, not 5%, but basically 2%. And during some of those times, we saw recessionary periods. We saw worldwide growth decrease during some of those times. And still, the stock market started at 1,000 and went to 10,000. You know, if you look at the PE in 2014, the trailing PE was 16.92. In 2015, 16.1. In 2016, 21.56. 2017, it was 21.77. And at the end of 2018, 15.47. The lowest it's been in 6 years. You know, the tax stimulus package raised profits significantly. It increased profitability. It increased companies' cash on hand, and it allowed companies to buy $1 trillion worth of stock back. You know, most of the time, guessing the stock market is a game of chess, not checkers. Richard Bernstein said that back a couple of years ago. He used to be the market analysis for Merrill Lynch. Richard Bernstein said, normally the chess is the game equivalent to the stock market. but today it's checkers. I mean, it's a far less difficult time right now to predict where the stock market is going. It may be a matter of time. I used to say that I still say I can predict the weather 100% of the time. I do. I have no doubt. I can tell you that in Seattle it will snow. That's 100%. Well, maybe 99.999%. I just can't tell you when. I can tell you it's going to rain. I just can't tell you when. I can tell you the stock market is going to continue to go up. I just can't tell you if it's going to be 2019 or 2020. But all the computer selling that has been going on will come to an end someday, and we'll see increases. And it could be more rapid than most times. Usually, recessions, downtimes take at least 90 days to get over with. This could happen a lot faster. Anyway, I'll be back next week to talk more about 2019 predictions and what's going on in the markets. Join me then. Until then, have a great week, great weekend, rest of the weekend, and I'll be back next week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.